Welcome back to the deep dive. You know, if you're building a portfolio, especially one focused on stable long-term income, you've probably come across DIF, the Digital Infrastructure Fund.
Oh, definitely. It's got that reputation, right? Stability, high yield, popular for retirement planning.
Exactly. But, well, we know the market rarely hands out guaranteed income for free. There's always something else going on. So we've gathered all the latest analyst reports, looked at the Q2 financials for 2068. We're trying to, synthesize what's really happening. Our mission today is to go beyond just that headline yield figure. We're digging into the Q2 performance, unpacking this really crucial lease renewal assumption that seems to underpin everything.
That's a big one.
It is. And maybe most importantly, we need to figure out why these top analysts have such, wildly different price targets for the fund. Okay, let's unpack this. Is DIF really the secure haven investors are hoping for? Or is its value basically hanging on one, maybe fragile macro factor?
Well, that macro factor is definitely central. Absolutely. But maybe let's start with the basics, the foundation, Q2 performance.
Good idea.
So when you look at the headline numbers, the net profit for Q2 came in around, 2.8 billion baht? Sounds pretty good on the surface.
Right, but as we always say, you've got to look under the hood, see what's actually cash.
Exactly.
And the sources, they all point out that this reported net profit, it included a pretty big bookkeeping item, an unrealized loss from asset valuation.
Over 222 million baht.
Yeah, which is, non-cash. It distorts the picture of the real underlying earnings.
Right. So if you strip out that non-cash loss, you get what the analysts are calling core profit, or sometimes normal profit.
The operational earnings.
That's the one. And that figure is actually closer to 3 billion baht. Now that core profit, that's the number that really matters. It's what fuels the cash flow, for the dividends.
And the performance there was solid, right? Met expectations.
Yeah, met expectations, showed a small increase. We're talking maybe 2.9% growth compared to last year, same quarter, and about 1.1% up from Q1.
So basically on track. The first half results make up just over 50% of the full year forecast. Seems steady.
It is steady, but what's interesting is where that little bit of growth came from. It definitely wasn't from rental income. That stayed pretty flat.
Yeah, 3.5 billion baht, same year on year, same quarter on quarter. Stable, but not growing.
Right, so the main engine for that profit bump, it was a significant drop in their costs, specifically interest expense.
Ah, okay. Interest expense fell quite sharply, didn't it? Like 13.7% year over year.
That's right. Big drop. Landed at about 480 million baht. And that decrease, that takes us straight into the future outlook because it's not just a one-off thing. It reflects the bigger picture.
The macro environment.
Precisely. The forecast now for Q3 2068 is that core earnings will probably keep growing slightly. And again, driven almost entirely by this ongoing benefit of lower financing costs.
This is where that macro connection, that interest rate story, really becomes the main investment thesis, isn't it?
Absolutely. It's the dominant theme.
And here's where it gets really interesting, I think. The sensitivity analysis. We already saw some benefit from that recent 25 basis point policy rate cut. But the analysis suggests that every 25 basis point cut adds something like 70 million baht to DIF's annual earnings?
Yeah, 70 million baht. That's a powerful number when you think about it. That's basically new earnings created just by the central bank tweaking rates.
And analysts are already baking in another cut, right? Before year end.
That's the expectation. InnovestX and others are pointing to another potential 25 BPs cut, and they see that as like the major catalyst for the unit price going forward.
So the story is clear. Falling policy rates are like wind in DIF sales.
Pretty much.
If yields on safe assets like government bonds go down, then DIF's already high dividend yield just looks way more attractive in comparison.
Right. That difference, that spread, it pulls money out of debt and into things like infrastructure funds that offer yield and, perceived stability.
But that stability, it really hinges on the long-term contracts, doesn't it? This fund relies heavily on just one tenant, True, who's also a major unit holder.
Yep. The revenue stream is described as fixed, stable. Minor rent increases expected each year, maybe 1 or 2%. Very predictable on that front.
But that single tenant structure, it's the strength, but also the risk, like you said.
It is. And the stability rests on this critical assumption baked into every single analyst model, that True will renew the fiber optic cable, the FOC lease, all the way through 2086.
Okay, wait, that's another 10 years past the current term.
10 more years, yeah.
So if the whole bullish case, all these high yield forecasts rely on this one renewal, how certain is that? Are analysts just hoping, or is there solid ground for it?
Well, the report suggests high confidence. They seem to think the necessary conditions for the renewal are already met. For them, it seems this long-term contract security is what lets them confidently project yields over 10% for years to come.
But without that renewal, the whole valuation changes, right?
Fundamentally, yeah.
Yeah.
It's the linchpin.
So, okay, the stable revenue shields it from some things, like trade issues or a general slowdown. The risk isn't really operational day-to-day.
Correct. It's financial and macro. The main vulnerability is if that interest rate trend suddenly reverses, if rates spike up unexpectedly.
Then that spread narrows, and the price justification weakens.
Exactly. The attractiveness diminishes relative to safer assets. It really is a relative value game right now. You're essentially betting on two things: continued easing from the central bank and the security of that specific lease renewal.
Okay, let's talk payoff then. The immediate return. DIF announced its Q2 dividend, right?
Yep, a cash dividend per unit, DPU, of 0.2222 BAT-stable. Flat year-on-year, flat quarter-on-quarter. Consistent.
And that consistency feeds right into these very bullish annual forecasts for 2068. The yields look huge.
They do. The predictions are really strong. The fund manager itself, SCBAM, is forecasting 0.90 BAT DPU for the year. That's roughly a 10% yield. InnovestX projects 0.88 BAT, implying maybe 10.4% yield. DBS Vickers sees potential up to 11.4%. Yeah. Krungsri Fifth actually projects the highest DPU at 0.92 BAT, which would be an 11% yield.
And Capricorn Securities notes the market IRR is attractive too, right? Around 7.5%.
7.57%, yeah. So solid return metrics all around based on these forecasts.
Which explains the confidence, but maybe not the massive range in target prices. Let's get into that spread. It's pretty wide.
It really is. You get Capricorn Securities recommending buy, but with a target price of 8.60 BAT.
Okay.
DBS Vickers also says buy, target 10.1 BAT. That's already suggesting decent upside.
Right. And then they climb higher.
Yeah. InnovestX has an outperform rating. Their DCF model gives a target of 10.5 BAT.
Okay, still climbing.
But the real outlier, the highest one, is Krungsri Fifth.
Yeah.
Also recommending buy, but with a massive target price of 12.90 BAT.
1290. That implies, what, 71% upside from recent levels?
Something like that, yeah. Huge potential upside, according to them.
Okay, so that's a 4.30 BAT spread between the low target at 8.60 and the high at 1290. For a fund known for stability, that seems like a massive difference in opinion. Why?
Yeah, it really boils down to the discount rate they're using in their valuation models. That's the key difference.
How so?
Well, a lower target price, like the 8.60 from Capricorn, suggests the analyst is factoring in a higher risk premium. Maybe they're more cautious about that single-tenant concentration risk, or maybe the execution risk around actually getting that lease renewed.
Okay, building in more caution.
Right. Whereas Krungsri Fifth super high target of 1290, that implies they're using a much lower discount rate. They're essentially treating that long-term income stream as almost guaranteed.
Assigning a much lower risk premium.
Exactly. They have very high conviction in both the lease renewal and the continuation of low interest rates benefiting the fund.
So that highest forecast is basically pricing in the absolute perfect storm scenario. Rates stay low or go lower, and that 2086 lease renewal is a done deal, no question.
That's a good way to put it, yes. And, this confidence, or at least the anticipation of lower rates, seems to be reflected in the market technically.
How's that?
Well, the reports note that after the unit price dropped quite a bit, recently there have been clear signs of buying interest coming back in. Money flowing back.
Which, again, circles right back to that macro story, doesn't it? That buying isn't really based on Q2 rental growth.
No, not directly.
It's based on anticipating those further policy rate cuts. Investors are actively moving money around, chasing the best risk-adjusted yield they can find.
And right now, a lot of them seem to see DIF as offering that attractive spread over safer debt assets, like bonds.
Okay. So let's try to synthesize this for everyone listening.
Yeah, let's sum it up. Basically, DIF's core earnings, they're stable, and they'll likely tick up a bit more, mainly because financing costs are falling due to lower interest rates.
Okay.
The fund's whole strategy, its value proposition, it's completely underpinned by this big assumption that the FOC lease gets renewed through 2086, locking in that income stream for a very long time.
Right.
And while the price targets are all over the place, the general feeling, the consensus, is overwhelmingly bullish. They're banking on that stable, high yield looking really good compared to a bond market where yields are expected to fall.
So, what does this all boil down to for you, the listener, maybe looking for long-term income? It seems like you have to view DAF right now as an investment whose price is being driven less by its day-to-day operations.
Which are quite stable.
Right, less by that and more by what global central banks are doing with interest rates. The foundation seems solid, but the price ceiling or potential upside is really tied to that interest rate sensitivity.
Well said. And maybe here's a final thought, something for you to chew on. Given that the fund manager expects around a 10% dividend yield, and the market generally thinks rates will keep falling, how high would the unit price actually need to climb before that dividend yield starts looking, well, fundamentally less attractive compared to just holding safe, high-grade government debt?
Ah, right. Where does that yield spread disappear?
Watching that specific correlation, that gap between DIF's yield and bond yields, that's probably the key factor to watch for future valuation changes. That's the balancing act.